All right. Today is Tuesday, August 24th. This is a recap for the stock market activities today. Kind of. Not really. We're gonna go over tickers. A lot of tickers. Yesterday you asked for tickers. Now I'm giving you tickers. And guess what? Now you're gonna bitch and moan again about where is the fundamentals, bro? We want fundamentals. So here's what I'm gonna do. I'm gonna go over the market activities today, a little bit of fundamentals, and then we will proceed to the tickers marathon. What happened in the stock market today? Nothing. It was a boring day, no activities at all besides meme stocks. Hold that thought. Looking at the heat map, what's going on here? The obvious is the risk on mode. We're dumping defensives, we're dumping REITs, we're dumping utilities, and even healthcare. These are the defensive sectors of the market. And we're buying offensive, we're buying energy, we're buying materials, we're buying industrials, financials, Chinese stocks bouncing higher today, the reopening names, technology all rising higher today. Two things in my notes here. Number one, the underperformance of vaccine stocks, Pfizer, Moderna, and BioNTech. I issued this tweet yesterday about Pfizer, suggesting that perhaps you want to sell the rip, short the rip, and I did buy put options yesterday on Pfizer. These options doubled in value today, so I dumped them all in, out, hello, goodbye. The other obvious thing is the underperformance of technology stocks. They managed to close in the green today, perhaps Amazon and Google doing the heavy lifting in the market today when it comes to technology, in addition to Shopify. Shopify has a deal with TikTok. They're going to have stores for celebrities and influencers or whatever within TikTok. But all in all, when we look at the advance to decline ratio, the NYSE, the SPY, the IWM all outperformed the NASDAQ today. Why is that? Perhaps we have to look at this moronic headline from CNBC. It says Treasury yields rise following Pfizer vaccine approval. So yields did not rise yesterday when the FDA announced the approval, but now yields have this lagging reaction and realized, oh shit, the FDA just approved Pfizer, let's go higher. Really? Or is it what I told you over the weekend? The market will have a reaction regarding the delaying of tapering. The market cares not about vaccines, the virus, fatalities, hospitalizations, nuclear wars, alien invasions. That doesn't matter. The end of the universe, that doesn't matter for the market. The market cares about the Coke and the trajectory of tapering. Over the weekend, I showed you this. We'll have a reaction regarding tapering from the dollar and yields. On Monday, both went down, and therefore pretty much everything rallied higher. Today, we saw a mixed picture. The dollar continues to show weakness, trading down, breaking the support of 93 at least at some point of the day. But yields moved a little higher, just a notch, a little bit, not by much, not by any significant mean that would cause a sell-off in the NASDAQ. If we move to 1.4, 1.5 rapidly, then the NASDAQ will have a problem. So we're shifting from scenario number 4 to scenario number 3, which was my expectations, by the way. And therefore, you're seeing a slight underperformance from the NASDAQ technology and growth names. So follow this guideline and you'll be fine. Of course, the permanent scenario will happen after the Jackson Hole meeting, after we have more clarity, more certainty regarding tapering. So again, did yields move higher due to the FDA Pfizer vaccine approval or due to what's going on with the expectations regarding tapering? And that is impacting the underperformance, if you can call it that, from the NASDAQ today. Okay, so we have a boring market today. Nothing moving, grinding higher. Same as usual, nothing new, besides the pop in meme stocks. Around midday, we saw huge moves, massive moves, in meme stocks, the likes of GameStop, AMC, rising double digits, midday, by the tune of over 20%. Now, the question you have is, what happened? Is it a gamma squeeze? Is it a short squeeze? Is it a stupidity squeeze? Who knows? From my understanding, looking at the options volume, there is a slight elevation here in AMC's volume, perhaps suggesting some sort of a gamma squeeze, but not really. So something happened today, perhaps some market manipulation, perhaps somebody spotted something, Perhaps a hedge fund or so is trying to prop up these names higher. We have low volatility for now. The market is muted. It is easy to do some market manipulation under these circumstances. All you have to do is an aggressive algorithmic buying program and you can pop anything you want. And of course, you pop it and then the retail side starts to buy calls. Perhaps they start to buy the stock. And here we go again. We have a mania. The majority of the rewards go to the early entrants, aka the hedgies and the institutionals who initiated the pop. And anyhow, you might be asking yourself a question. Where is the SEC? Where is the SEC? The market is becoming an unregulated jungle. Pumps and dumps all over the place. I got news for you because the SEC is in a coma and has been in a coma for years and years and years. The SEC chairman says, this is Gensler by the way, he demanded or will demand, he's still thinking about demanding, that more than 250 Chinese companies trading in US markets better inform investors about political and regulatory risk. What is he going to do? Send you brochures? Hey, by the way, Chairman Xi can crash your stocks anytime he pleases or pump them anytime he pleases. Proceed with caution. And the beauty of this guy's job is he wakes up in the morning, puts a suit on, drinks a cup of coffee, and then he goes back to sleep. So the market will remain an unregulated jungle until the crash happens. And it will be a severe one due to the margin calls and all of that stupidity that has been going on throughout this bubble. But an important thing to note here is the pattern, the correlation between meme stocks in the general market, specifically the NASDAQ, the SPY, the big cap technology names. When meme stocks surge higher, impulsively so, we have another episode of the mania, we see weakness in the broader market. So now that meme stocks popped higher, 20, 30% in certain cases, what do you think will happen tomorrow? The retail side will wake up again and say, you know what? The casino's back again. The game is back again. Let's play the game. Let's buy some meme stocks. Let's buy GameStop, AMC, Workhorse, and other meme stocks. If we see another pop higher tomorrow, 10, 20, 30%, you bet you will see weakness in the market in general because it has been the correlation since the beginning of the year. With that being said, let's move on to the purpose and the main subject of this video. About a month ago, I made a video studying charts prior to earnings. Some of these charts moved significantly since the release of that video. So my intentions are to go over all of these charts. I will play back what I said and I will give you a follow-up on these charts. And the purpose here, of course, is to learn, to get better in technical analysis. You have to learn from prior calls what we got right or what we got wrong. What we got right and what I got wrong. See how I take responsibility? And without further ado, here we go, back in time. When we look at the weekly chart, it is highly extended. When you look at the RSI indicator, for example, the Relative Strength Index, it is reading at quote-unquote overbought territory, meaning that this is a stock to sell, not to buy. Mind you, the RSI doesn't tell you any buy or sell signals, but it tells you buy and sell zones. And we are now at the sell zone, meaning that perhaps the best of the gains are already behind us. Likewise, when you look at the MACD indicator, you see all of these circles, all of these bubbles that I'm highlighting for you. These are all points where the momentum weakened and we saw a dip in the stock. Yet we saw a rebound in the momentum every single time. What does that say? It says that there was strong consensus among money managers and investors alike to buy the dip in this stock at any and every occurrence. Now, that could happen after earnings and we see another dip, but the stock at highly elevated levels. Once again, up over 50%, the best of the gains are behind us. And the setup is setting the stage for a disappointment, regardless of how good the earnings out of Google will be. Of course, the stock had a massive pop higher last week on the heels of Snapchat's earnings. But be careful here of assuming that the earnings from Google will match the success of Snapchat. Two different companies with two different capacity for growth. All eyes, of course, will be on YouTube's earnings, the growth of YouTube within Google. But once again, we're looking at the technicals, not the fundamentals. And the technicals say this is not a buyer stock. This is a seller stock. It's already overextended. The likelihood for disappointment is highly likely. Okay, so the chart of Google continued to move higher after earnings. The earnings came out impressive, exceeding all expectations, specifically the growth of YouTube's revenue. And rumor has it that a single YouTuber by the name of the Maverick of Wall Street is single-handedly responsible for tripling the revenue of YouTube. But all jokes aside, the reason why I was using the Fibonacci retracement levels, even though the chart hasn't reversed yet, is an anticipation of a reversal. Now that did not happen, which makes the Fibonacci retracement absolutely useless until we get a confirmation for a reversal. The chart is overextended, quote-unquote overbought in extreme fashion, as if there is an autopilot buying program, and we know that institutionals love this stock. They continue to buy it over and over and over again. Perhaps this is a better way to look at the chart. We have a series of higher lows until and unless the series of higher lows is breached and negated, the chart will continue to move higher. And my threshold is $2,522. If the chart pulls back to that level and it breaches that level, then we have a confirmation of the reversal. And this reversal will be accompanied by a massive flush down. The reason is all of this institutional accumulation of the stock since the beginning of the year will be unwind at the same time. Everybody rushing to take profits at the same time. For now, we have zero reversal signal at all. Nothing at all. Do you buy this chart at these levels? Of course not. This is suicidal. Do you short it? No, you don't, because you don't have a reversal signal yet. But this will be an excellent chart when the reversal happens. A lot of technical analysts use the bands as buy and sell signals. I don't use them that way at all. I don't see the bands, the Bollinger Bands, as offering buy or sell signals. What they indicate instead is the strength in the trend of a certain stock. And as you can see, this is a weekly chart for Microsoft. Microsoft is already trading above its Bollinger Bands. This is an indicator for strong strength in this stock. And usually when the stock trades at these levels, you're not going to see a massive drop. Instead, you see a pullback, some consolidation, building energy, and then continuing the move higher. Another perspective for the chart, this is again a weekly chart for Microsoft. The chart has been trading within a defined channel, defined peaks, and defined valleys. In recent weeks, the chart broke above the trading channel. This is usually a bullish signal, indicating that the stock will build on more gains. And here it is, Microsoft moving higher. We talked about the strength in this stock using the Bollinger Bands. And indeed, the stock moved higher. Now, I happen to own the stock, but this move is so impulsive, it is ridiculous, and therefore I unloaded 50% of my position. Can it continue to go higher? Of course, yes. But the most likely scenario is, after a breakout from a channel like this, you're going to have to go down and retest the upper range of the channel. And either the stock is going to fall down into the channel, or it will bounce back, and this will be an extremely bullish signal that the stock will move on comfortably, with certainty this time, to all-time highs. But from a technical setup, the consolidation within range is a process of building up energy. And this energy will be released, shall we say violently so, one way or the other. Playing the odds here, you look at the MACD indicator, you look at the RSI indicator, all turning the corner and trending positive once again. In addition, if this stock wanted to go down, it had about a year or so to do so. It did not. It decided to consolidate within range, waiting and waiting and waiting for earnings to catch up with the valuation. If the report comes out decent, my expectations are that if the earnings report is decent, beating expectations, sizably so, I believe that this stock will pop higher out of the consolidation range. The technical setup alone looks positive for the chart of AMD. And here we go, AMD popping higher out of the consolidation box. We saw a massive pop of about 33%. Of course, we played this one via options, but now the stock is pulling back. The typical behavior is for the chart to go down, retest the upper band, the upper range of the consolidation box, and then it bounces higher. This is the bullish scenario. The bearish scenario is that the chart will fall down back into the consolidation range. For now, it looks like AMD has what it takes to continue to move higher. We had somewhat of a bounce slightly before visiting the upper range of the consolidation box. Perhaps we could go down again just to make sure, retest it once more, and then the chart bounces higher. For now, the momentum indicators, the MACD and the RSI, still have a little bit of room to go higher before the momentum cools off. When we look at the symmetry of the chart, for example, this is still a weekly chart, by the way. You can see the last time we saw this setup from a candlestick perspective, Facebook took a break, a little dip, and then built on the rally. Facebook remains one of the so-called value stocks within big cap technology names. My expectations here are the stock popped higher on the heels of Snapchat's earnings. But once again, two different companies, two different setup. You cannot compare one with the other. And when the stock moves ahead of time prior to earnings, you risk the phenomena of buy the rumor, sell the news. So looking at the charts, the overextension, the symmetry, my expectations are the stock will pull back slightly, perhaps for a week or two, and then continue to build on the rally because the valuation in this stock is still attractive. Okay, and here it is, Facebook weekly chart. The symmetry holds, pretty much identical to the first time. The problem is in the chart that we're looking at right now, it is topping from a momentum perspective. You see the RSI already trading at a quote-unquote overbought zone, and we have the MACD indicator losing some momentum, topping here, curling down, and perhaps it is about to register some red impressions on the histogram. If that happens, then we have a confirmation of the loss in momentum. It doesn't mean that Facebook will go down or crash. It will just mean that the stock lost a lot of momentum and it could consolidate here for a little while. This chart moved higher, significantly higher, but it had significant pullbacks. And now we're seeing a series of higher highs and, shall we say, higher lows. We still don't have a confirmation that this will be a higher low. But if you're assuming that this will be a higher low, then the stock will continue to move higher. Of course, earnings are critical. The chip shortage is important. Inflation is important for this company. Multiple factors. But from a technical setup alone, what do you do with this chart? The momentum is still strong from a MACD and RSI perspective, but once again, slightly overextended here. And what I'm looking for is a formation of a higher low, and then I will consider adding to my position. Or if some of you don't have Ford in your portfolio, you've been waiting and waiting for an entry point in the stock, if you see a higher low, and this is a confirmation that the trend will continue, and we will see a formation of a higher high, and therefore it becomes a decent point of entry in this stock. Here is an update for Ford. What's going on here? The chart moved a little lower. Can we say that this is a lower low? Not really, because all in all, when you look at the weekly chart, it is still maintaining the bullish trend, higher highs and higher lows. Until and unless this is negated, the chart will likely continue to move in the same trend, making higher highs and higher lows. Of course, earnings played a role in pushing the stock down in addition to the chip shortage, and we have problems with GM. Their EV bolts are blowing up, and therefore we have some pain in GM, and this is dragging Ford down with it. But fundamentals aside, the technicals are still intact. We have a rising wedge pattern, which is usually a bearish pattern, indicating that once the stock trades out of the wedge consolidation, we see a pullback, perhaps a significant one. We have no bearish indicators from a momentum perspective. Both the RSI and the MACD still have plenty of room to rise higher. But one cannot help but to notice the rising wedge formation. There is still a lot of room to go, a few months or so, before you get to the end of the wedge. But usually charts start to break out of the wedge consolidation prior to reaching the end of the wedge. So we are expecting a move here in MasterCard, and the assumption is that the move will be to the downside. And here we go, MasterCard breaking the rising wedge pattern as expected. The fundamentals, we have some negative news for MasterCard. They're being banned in India, and we have another fresh round of lockdowns in other countries. We have Delta slowing down things, the reopening. But the fundamentals aside, when a chart breaks the rising wedge pattern, it doesn't just breach the pattern for a little bit and then bounces higher again. The likelihood is we will see more pain in this chart. This is a weekly chart, and once again, consolidating within range for about a year or so, not doing anything at all. Why? Because the stock already priced in all of these gains and earnings and growth. And now it is waiting and waiting and waiting for earnings to catch up with the valuation. We have a breakout above the consolidation range, but I'm hesitant to say that this is a legitimate breakout. It could be a false breakout, and the next thing you know, the stock drops back within the consolidation range after earnings. So my expectation looking at this stock is it will probably still go back to the consolidation range and trade sideways, because while earnings will be impressive, it is extremely hard to see any growth year over year. And therefore, I believe that this stock will continue to consolidate for a little while, for a longer period of time before it starts moving out of the consolidation range. And here we go, Amazon down, back to the penalty box, back to the consolidation box. This was a tough one, by the way, because the technicals were positive. Therefore, the pop higher out of the consolidation box was a bull trap. But it didn't fly by me, by the way, because I combined the technicals with the fundamentals. The stock moving higher pre-earnings prematurely, when the likelihood was that the upcoming earnings report will show a slowdown in the growth year over year for the company. This was expected, by the way, and therefore the stock is moving down. Amazon told you, folks, last year was exceptional. Don't expect us to replicate the performance of last year. And therefore, the year-over-year performance is down unless we have another pandemic and we stay at home and continue to spend. And even then, we will need more stimmies to prop up this stock higher. For now, the likelihood is the stock will consolidate in this range for a little longer before making up its mind. Do the fundamentals and the earnings, perhaps in the next quarter, support the stock moving higher, support the stock's valuation, or this stock will go down, breaking the consolidation box to the downside? That remains to be seen, but for now, Amazon is dead money. We know the story. Growth and momentum went out of favor, and value / the inflationary stocks went in favor, and therefore we saw TWLO trading down for weeks and weeks and weeks. In doing so, forming a wedge pattern, and now it has broken above the wedge, above the descending line of the wedge, which is usually a bullish development. Likewise, looking at the RSI, the MACD indicators, the momentum still has plenty of room to go, and it is turning bullish positive once again. Therefore, the technical setup says, show me the earnings, and if the earnings are good enough, we're ready to go higher here in this stock. You can also argue that we're starting to see a reverse head and shoulder formation. The technical setup for this stock is bullish. And here we go, TWLO weekly chart did not work out as I expected, not we, I take the blame. But if you look at it still, the reverse head and shoulder pattern still intact, paving the way in the possibility that this chart could still blast higher at any point from this point on. The problem remains the fundamentals. Let's say yields pop higher. If they do, for whatever reason, perhaps the Fed tapers or doesn't taper, it depends on the mood of the bond market. We know that the bond market threw a fit when the Fed made it clear that tapering will happen, and yields went down, bond prices went higher. Contrary to the common knowledge, because the Fed is the sugar daddy who's been buying over half of the supply of bonds. When that sugar daddy tapers and they stop buying bonds, guess what? Prices of bonds will go down and yields go higher. But the bond market reacted as if it's warning the Fed. If you taper, you're going to slow down the pace of economic recovery, and most likely you're going to crash the stock market. Now yields are moving higher, a little higher, we will see, as tapering gets kicked down the road, being delayed. This is the assumption, no certainty. Weird behavior in the bond market, but if tapering is delayed and yields move higher, then we have a confirmation that the bond market is saying this is not the right time to taper Fed. Mr. Powell, we have a zombified economy, a zombified stock market, both hooked up on drugs. If you remove the drug, the party will crash. The party will be over. This is at least the behavior of yields right now. The moral of the story here when it comes to TWLO, a classic growth momentum stock. If yields continue to move higher, then we will see the weakness continue. If yields drop, then the likelihood is this will be the tide that lifts all boats when it comes to growth and momentum stocks, including TWLO. So the technicals could say one thing, but you always have to pay attention to the fundamentals. For now, to me at least, the technicals are intact in this chart until and unless the reverse head and shoulder formation is off the table. And it will be off the table if the level of 280 of support is breached and violated. We have a gap since that move in November, and the likelihood is that this gap will not be filled. And the reason is the stock has to go down 30% or so to close this gap. Why would Chevron go down 30% to close the gap? Unless we have a disaster regarding the Delta variant and we see oil prices going down severely, then the chart of Chevron will go down, closing the gap. For now, it is pulling back from an impressive move higher. You see the MACD crossing, that was the signal to take profits from that one gigantic leg higher since the elections. And the stock indeed pulled back, but in the process, still making higher lows. And this is what we're watching for. Will this be yet another higher low? And if that is the case, then the bullish trend remains intact. Of course, the stock is trading higher today, but who knows what will happen by Friday. What I'm watching for is the formation of a higher low. If that doesn't happen and the stock starts to go down, forming lower lows, then we get a problem in this stock, a big one. My expectations are when you combine the technicals and the fundamentals, the stock will hold the higher low and move higher after the report. Here we go, CVX, Chevron, what's going on here? It moved slightly lower on the mini crash of crude oil prices last week. But now they're rebounding higher again, and so is the stock of Chevron. The likelihood is the higher high will hold and the stock will break above 100 once and for all in an impulsive fashion. But again, I hate to be a parrot. In a chart like this, the technicals are one thing, the fundamentals perhaps hold more weight because the chart tracks the price of crude oil. Crude oil tracks the dollar and yields. The dollar and yields track the news, delta, tapering, etc. The question is the damage already done? Is the correction already over? When you look at a MACD or RSI perspective, for example, from a weekly chart, there is significant weakness. The momentum is way weaker than it was before, meaning that the appetite for buying the stock is fading away. So the earnings report will be extremely important to re-solidify the thesis that this stock should move higher. Now, I'm looking at the MACD indicator from a weekly perspective. Are we starting to see the worst in this correction is behind us and we're seeing a saucer bottoming formation? It is too early to say so. Likewise, is the RSI also gathering some energy, readying to move higher? The stock is certainly showing a lot of resiliency by climbing back and attempting to retain the Fibonacci retracement level for support. And this retracement level is at around 210. Now, let's combine the technicals with the fundamentals. We have a massive infrastructure spending bill to come. Trillions and trillions of dollars, which means that this will be a good catalyst for Caterpillar. The main question is all of that already accounted for in the move in this stock? And if that is the case, then the weakness still has some room to go, and the stock will go down after earnings, all the way down to the next Fibonacci retracement level of around 185, 186, and at that point, the stock will be at a buy zone. For now, the stock remains a little too elevated for my taste, and I believe that the bear flag formation still has room to materialize a little lower, meaning the stock going down to 186, 185, and that will be a solid buy signal because 185, 186 is an excellent support. In addition, by that time, the stock will become extremely oversold. Here we go, Caterpillar still hugging the Fibonacci retracement level of around 210. Back and forth, no definitive move one way or the other. But look at the MACD indicator. Look at the histogram. These columns, the red columns, are getting smaller and smaller and smaller. What does that mean? It means that the negative momentum is bottoming and the chart is moving ahead to create some positive momentum. What would be the catalyst for Caterpillar to pop higher again? It would be the upcoming infrastructure bill. Looking at the technicals alone, the stock moved significantly higher off the support of 339, breaking above the descending resistance line, and now it is consolidating in what it appears to be a bull flag formation or a cup and handle formation. Both are positive bullish formations, and therefore I view the dip in the stock today as an opportunity to buy. Yet keep in mind, this is not a trading stock. This is an investor type of stock, meaning that you buy it and you keep it in your portfolio for a long time with the goal of capturing a safe 3% or so in dividends. And here's the update for LMT. Boy, that handle is melting down. Perhaps the cup is too hot, yet my outlook did not change at all. The chart is still trading above 330. The chart is still trading above the descending line of resistance that was broken before. And when you look at the fundamentals, we have a president, Joe Biden, who's under fire. They're calling him weak. They're calling him a disaster. And we know when American presidents are under pressure politically, they do something crazy, usually by bombing something. For example, Clinton, when he got caught doing some funny business under the table, he decided to distract and bomb something. And we saw bombing of Iraq and Sudan, etc., etc. Now Biden is under pressure, so he's going to bomb something to assert his power, memory, who knows. And when that happened, of course, people will rush to buy all of these defense stocks. For now, technically speaking, the range between 380 and 400 was expected to be a range of resistance, as it acted before. But the chart is pulling down to gather some energy, to gather some new blood, asking over and over and over again, hey, dip buyers, anybody interested in this stock? Anybody interested in a dividend stock? If that call is answered, and the likelihood is it will, the stock will bounce higher again. When do we start shitting our pants? If 339, 340, to be conservative, is breached for support, then we get a problem in the stock. This is a weekly chart, and this chart is looking extremely bullish here. We have a defined resistance line at around 148. You could go 150 to be conservative, but we also have a rising support line. What does that mean? The chart is strengthening every time it creates a higher low, readying to break above the resistance line once and for all. It has been the resistance line since 2018. It was the previous stop. And now the chart has another shot to break above this stop once and for all. The technical setup for this stock is extremely bullish. Now you have to combine that with the fundamental setup by looking at prior earnings reports and what are the expectations for this upcoming report for Electronic Arts. I'm not sure if they have new releases, which will be a catalyst for the stock to move higher. The Legend of Apes or Apes Legends or whatever you guys are playing, doesn't matter to me, but the stock needs a little more excitement in the next earnings report to break above the resistance line once and for all. And here we go, an update on EA, Electronic Arts. This is a weekly chart, and guess what? The chart did not break 147 as resistance. It actually broken the support line. The trend line was broken. The good news is, while the trend line was broken, the chart did not make lower lows. The series of higher lows is still intact. I remain bullish on this chart that the likelihood is it will give it another shot. This will be the last shot for EA to break above 147 once and for all. If it fails to do so, then we will have the definitive final rejection and the chart will flush down. For now, I remain bullish on this chart. But to play the devil's advocate, here it is, the weekly chart of Take-Two, another video games publisher, the ticker TTWO. In this stock, contrary to the formation in Electronic Arts, we're seeing a head and shoulder formation, which is a bearish formation, indicating that the stock will go down, and it will be a sizable drop, perhaps all the way down to the trend line that you see in yellow. And here it is, update on the devil's advocate of Take-Two. The chart moved down after earnings. The head and shoulder formation remains intact. The chart looks a lot weaker than EA. Will it go down all the way to the trend line? It could, and therefore the assumption is that the head and shoulder formation will play out and the chart will flush down. Therefore, I will not touch this chart at all. The only way this chart turns bullish again is to negate the head and shoulder formation by closing above the last shoulder, which happens to be at around 190. And therefore, we have a great setup, fundamental setup for this stock to move higher. It already moved higher, triple digits. And now what? We're seeing all of these inflationary stocks pulling down double digits, 10, 20, even 30% in certain cases. And the main question is the inflationary trade dead? The answer is, in my opinion, not really, because we still have the fiscal spending to come in terms of infrastructure. So watch out for this name. It's a bullet stock. What is a bullet stock? It's a stock that works when we have pricing wars, when we have severe competition in certain industries. You go back to the source, the provider of the bullets, not the stocks involved in the war. We have an EV war. Well, all of these EV manufacturers need aluminum. We have an infrastructure bidding war. All of these firms will compete to get a contract from the government. Well, guess what? Alcoa provides all of that aluminum regardless of who wins the contract. And therefore, it is a perfect bullet stock. Now, let's talk about the technicals. We have a consolidation range, a descending channel consolidation range after a massive move higher in the stock. This is a bullish setup, not a bearish one, and the stock is already breaking above the consolidation range. We need a confirmation this week. When the confirmation happens, then the stock will move higher, perhaps creating higher highs once again. We see the double bottom formation in the momentum indicators, the RSI, the MACD, indicating that the stock is ready to move higher. The momentum is already bottomed and it is ready to build on again and move this stock higher. My expectations are Alcoa moves higher. Alcoa, here's an update. The chart popped higher to the tune of about 25%. Although last week we saw some risk-off mode in the market, all of these names, the infrastructure names, the inflation names got sold off, Alcoa included, and it pretty much erased the gains altogether. Now the chart is moving higher again. This is a highly volatile chart. The inflation trade is a highly volatile trade, and the reason is we're waiting and waiting and waiting for the outcome of delta, or perhaps more importantly, the outcome of tapering. Here's another way to look at the chart. We had a move higher and then a few months or so of profit taking from the first leg up. It was a downtrend with lower highs and lower lows. Now we have a breakout higher again, a continuation of the first leg. The chart is making higher highs and higher lows. The assumption is the bearish trend, the sell-off profit-taking period is over, and now we have another accumulation period. The assumption is that the accumulation period will continue pushing the stock higher, but you always have to keep an eye on the US dollar and yields, because this is a highly sensitive chart to the outcome of the US dollar and the 10-year yield. And there is plenty of room for the stock to go higher because the momentum is strengthening once again. Of course, the stock is expected to face some resistance at the prior all-time highs, so you could play a short trade there. But for me, I wouldn't do that because the time for shorting this stock was already back a few months ago when the MACD indicator crossed to the downside. If anything, this is a stock to buy at this point, at least from a technical perspective. Who knows what the fundamentals will show? Who knows what the earnings report would show? But from a technical perspective alone, you don't want to bid against this chart. Oh boy, here we go. The expert got it wrong again. We were expecting a pullback at the prior highs, the double top, but not by this much. This is too much of a pullback. And the reason is we have fundamental reasons, of course. ROKU's earnings showed that the streaming habit is slowing down. So they were beneficiary of last year's stay-at-home environment. This year, after the vaccinations, the reopening, the stock is starting to lose momentum. But now we have Delta, and the consumer is changing habits once again, reverting to the stay-at-home mode. If they do, then the likelihood is ROKU will bounce higher again. The technicals are still intact for a possibility of a pop higher. Why? Because we have, from a weekly perspective now, a cup and handle formation. Until and unless the 275 Fibonacci retracement level is breached, the chart will remain dangerous to short. The MACD indicator is yo-yoing back and forth between positive and negative. Again, I hate to parrot myself, but the technicals for this chart will matter less as the fundamentals take center stage. If yields pop higher for whatever reason, ROKU will crash. If yields continue to hover at these levels or perhaps trade lower, then this will be good for ROKU, other momentum and growth stocks to move higher. In other words, you have to wait for the conclusion of tapering and what the bond market wants to do before shorting or buying these kind of stocks, the high growth and momentum. The big cap technology stocks, these will be fine. They will hold until the very end. These will be the last to crash in the case of a market crash. But these growth and momentum stocks will be the first to crash if yields pop significantly higher. Because this is yet again a bullet stock. If you are betting on food inflation, grains inflation, the rise of commodity prices, this is one of the best plays in that arena, whether you're betting on wheat prices to go higher or grains in general. Finally, we saw a massive correction in this name. Double digits correction. This is a daily chart, by the way, and you can see that the momentum indicators are bottoming. The RSI, the MACD, they're at the bottom. They're at severe oversold conditions. This is a high conviction buy from a technical perspective, at least for me. The name will report earnings this week. My expectations are, at least from a technical setup, this stock should move higher, and I will not hesitate to buy the dip in this stock, at least from an options perspective. And here we go, ADM. This is a daily chart, by the way. As expected, the chart popped higher by the tune of about 9% before pulling back again along with other inflationary stocks last week. Now, this is not only an inflationary stock, this is also a safety stock in case of shortages, in case of stay at home, in case of inflation. It's an emergency stock. It's sort of a zombie apocalypse kind of stock because it produces the majority of wheat and grains in the country, in addition to fertilizers. What do we see in the chart here? If the chart continues to bounce higher from this point on, then we have a higher low. The RSI, the MACD continue to be open for a rally here in the stock. Again, the parrot says, watch yields and the US dollar. If the dollar continues to slide down, then this chart will pop higher. This is a weekly chart. We have a wedge consolidation, and the chart is breaking out of the wedge consolidation in a bullish behavior. It's breaking up higher. We're seeing a significant strengthening in the MACD and the RSI indicators. These are all signs and signals for a bullish setup in this stock to move higher. Here's the update for Autodesk ADSK. This was the thumbnail of the video, and the question was, is it going to go to the moon? It did go to the moon, if by the moon you mean about 10% pop. We have a confirmation of the crossing in the MACD indicator. The RSI pushed higher, now reaching the so-called overbought zone. It doesn't mean that it has to pull down, but it means that perhaps the best of the gains are now behind us. So if you followed this one and you bought call options, perhaps this is the time to book some gains. What do we do now in this chart? Because there's nothing you can see here. There is no technical significance whatsoever in this chart. And this is a weekly chart, by the way. But the stock did a 180, going back all the way to the prior levels before the Archegos Capital Mania, which makes it back again a value stock. What do we do with this one since the technicals say nothing at all? We follow the fundamentals. I have no doubt in my mind that in the next earnings report for this company, Discovery, you will see that the rate of growth and the momentum in the Discovery Plus streaming service is extremely impressive. These are highly addictive shows provided by Discovery. It's all toxic garbage, but people watch it anyways. Addiction is good when you are a streaming service. You want your customers, your viewers, to be addicted. They need more and more and more supply of these garbage shows, and they're getting them from Discovery Plus. Therefore, my recommendation is, if you like the stock, buy it. Don't trade it. Buy the stock and hold it in your portfolio. You will be rewarded in the long term. And here we go, Discovery, no update at all. It is still trading within range, but we're getting closer and closer and closer in the weekly MACD to make a crossing to the positive side, creating green impressions on the histogram. Again, this is a own it, don't trade it stock. If you like the stock, own it. Buy the stock or buy call options. And if the stock moves higher, you get to exercise the options and you own the stock. This is a company that produces garbage TV shows, but these garbage shows are highly addictive. Look no further than my wife, who sits all day and binge watching these garbage shows, and therefore Thankfully, I have other sets of televisions in the house. So perhaps another way to play discovery is to buy stocks of TV manufacturers, the likes of Vizio, because husbands are going to buy TVs in response to the wife's addiction to garbage shows from Discovery. And let's talk about bonus charts. They were not included in that video, but in videos are produced later on. Let's get some updates here because some of these charts moved significantly one way or the other. Starting with Micron. We have a bullish formation. This is called falling wedge formation for all of you purists. Don't call it a reverse hammer, bro. Call it a shooting star. Who cares? I can call it a choking pig for all I care. If you don't understand the psychology behind the pattern, it doesn't mean anything at all. Here we have a falling wedge pattern, a massive ride higher, a consolidation, lots of profit taking, a period of weakness that stretches out for months and months. And then, as earnings catch up to the valuation, as the sentiment change, we see a continuation of the original move and a breakout higher from the wedge consolidation. So watch out for Micron. But here's the take. Give yourself a lot of time if you're going to buy call options. Number one, AMD could be topping. We could see a flush down in AMD. And now there's talk about the NVIDIA ARM deal. The British government is working to stop that deal. And that could take NVIDIA to the barber shop for a haircut. And if AMD and NVIDIA go down, they will take the ETFs down, the SMH, etc. And this will take Micron down too. The point here is, continue to watch this chart for a bullish breakout. Here's the update. What a heartbreaker this is. It went down again, massive flush down, even though everything was looking as set in stone for a pop higher in Micron. But the chart goes down. Why? We have fundamental news. The shortage of DRAM got worse. And of course, these stocks, the memory stocks, the likes of Micron, WDC got whacked right away. The silver lining is the stock is holding, trying extremely hard here to hold on the wedge pattern, perhaps to give it another shot to pop higher. Am I interested in buying this stock again or buying calls? Not really. I see the fundamentals having more pull and sway than the technicals in this chart. For now, we have a strong support level at 70. So I will continue to watch the 70 level. If that one is breached, then we're going to have a big problem in the stock. Why Roblox? The ticker RBLX. There's all this talk about China cracking down on video games, yada yada yada. The chart has been on a downtrend for months now, a massive downtrend. Are we seeing the end of that downtrend and a change of course? I'm looking and anticipating a breakout higher above the descending line. My leading indicator is the higher low that the chart printed today. If the higher low persists, the assumption is Roblox will break above the descending line. And here's the update on Roblox. Popping higher, and since the video was made, the stock booked about 17% gains. The beauty of this chart is it went down after earnings and it retested the prior lows. So we have somewhat of a double bottom. It retested the last low before popping higher again. So if you missed it the first time, that candle right away after earnings, that was the green light for you to load up on this chart because it retested the bottom, it retested the prior low, and it managed to pop higher again, indicating that the stock has a lot of momentum here. I will be eyeing 95 as the exit point because the likelihood is the momentum will top at that point. It was a prior level of resistance. The chart pulled down from that point before. So as the chart gets closer to 95, perhaps 90, 93. This is a good point for an exit. If you wait until 95, the likelihood is the chart will pull back before 95. And this is a typical trading behavior, by the way. Professional traders try to book profits ahead of the resistance zone. They don't want to wait till last minute, risk a flush down, and then they scramble to book profits. You book profits while the chart is going your way. Lastly, what about LVS, Las Vegas Sands? What a beating this chart got. Brutal, absolutely brutal. Week after week after week. No mercy at all. Down 40% or so in a few weeks. We know the reasons, but let's talk technicals. Oversold from a daily perspective. Oversold from a weekly perspective. Absolutely hated this chart. What does that mean? A fertile ground for a rebound in the name, meaning it's an opportunity to buy call options ahead of time. It is speculation, but it is educated speculation. There's always a degree of risk here, but at this point, any good news for the company could spark a short covering rally. All of these shorts sitting on a lot of gains. They're gonna have to book them at some point, and this point is perhaps coming very, very soon. And here is the update for LVS Las Vegas Sands. We were a little early here by about a few days, but the chart finally popping back higher. It caught almost the double bottom from last time around, and now it is bouncing higher. The bounce so far is reaching about 17% gains. So even if you bought call options back then when I talked about the chart, these call options are in the money right now. We will see a lot of short covering if the China debacle is over. This is the assumption. We have no confirmation that this is over. The Chinese are trying to calm the market down. And if they continue to do so, we will see more and more short covering, and this chart will move explosively higher, along with other Chinese names. Here's a bonus ticker for you. No guarantees, of course, but perhaps an oversold and hated stock rising from the dead. This is the chart of SPLK. One way we can see the chart as a cup and handle formation, which will break to the upside. Another way to see it is a bull flag consolidation, which will push the chart higher. Here's another one, a reverse head and shoulder formation. And here's another one, a descending line of consolidation, resistance, and it was broken, and now the chart is trading significantly higher, meaning that the bearish pattern, the bearish trend is over, and now the chart is attempting to create a new, fresh, bullish trend higher. Now understand this, if the Nasdaq as a whole and the software sector of the market goes down, then SPLK will not be the only survivor. Therefore, you have to weigh the risk versus reward. The technicals say that this is a bullish chart. You gotta buy this chart. And here it is, the last update on SPLK. This is a weekly chart, and indeed the chart is moving higher. This was a solid buy, and now it is departing away from 142 in the right direction higher. It still has plenty of room to move higher from a momentum indicator's perspective, the MACD and the RSI. Perhaps if yields pop higher, we could see a sell-off in the Nasdaq, big cap technology names, even software names. But this stock could, I say could, not would, a lone survivor here, because the sell-off in SPLK already happened before. My profit target zone is around 170. Of course, all of this will depend on your expiration date for your calls. If you have a sooner expiration date, you want to take profits quickly. If you have a later expiration date, then you have more flexibility in being a little more greedy. Anyhow, folks, this is the end of the marathon of tickers. Let me know your feedback in the comments. Should we do more of these videos, the charts to watch and then updates on them? Anyways, that's all I got for you for now, but I will talk to you again tomorrow.